Reserve has cut short-term interest rates, and here to talk about that impact, we are joined by Gabe Rockers with Edward Jones. Gabe, thanks for joining us today.
Thank you all for having me and allowing me to sponsor this segment.
Of course. We are happy to be talking to you. So as I mentioned, we're talking about interest rates. Short-term interest rates have been cut by the Federal Reserve. And so we're going to be talking about kind of the impact that will have on us as consumers and as investors. So Gabe, why don't you start us off with first, what's the potential impact on our purchasing abilities?
Okay, so yes, as you mentioned, Mary Grace, the Fed did cut rates for the first time in approximately 4 years. Coming out of their September meeting, we've actually seen an additional 25 basis point or 0.25% cut that came out of their November meeting immediately following the election. What that really means for consumers is, as we need to borrow, the interest rate or the rates attached to that loan should be on the decline. So that should be favorable for consumers who need to borrow, and frankly, that's most of us. The things that I think tie that interest rate environment or borrowing most closely to would be auto sales and housing, but also we could touch on the credit card side as well. I expect to see a more immediate impact in rates on the decline tied to both home loans and autos. We would expect rates attached to finance for a car loan to come down pretty quickly. We should start seeing some movement in the fixed side of mortgage rates. I believe we've seen that in some sense already. And eventually, here pretty quickly, I would expect we'd see adjustable rate mortgage rates start moving in a positive direction for borrowers. So home equity loans should also be in decline. The one that may take a little bit longer is the credit card rates. Those rates don't tend to move as fast as home and autos. And sadly, with the massive increases to rates in 2022 and early 23, credit card rates are significantly high. And so consumers may not see quite as quick of relief there or as much relief quickly, but that should too be moving in the right direction.
Excellent. So that's good to hear. For credit card users, don't expect that to be very drastic. Those rates will be moving slower. But as far as other loans, as you talked about, car, home loans, we should be seeing hopefully some positive impacts from that rate cut. Let's move to investors. What do lower rates mean for us in that role?
Generally speaking, lower rates are a real positive to really both stocks and bonds. On the stock market side of it, when companies need to borrow to fund future operations, if the rates go down, their borrowing costs go down, and that kind of immediately expands their profits or increases their profit margin. Stocks do tend to follow profits, so that is a positive thing for stocks overall in general. Bonds, they also could experience some positivity from rates on the decline. Bond prices tend to move in an inverse relationship to interest rates. So when rates go up, bond prices go down. When rates go down, bond prices come back up. And the reason is if rates are on the decline, a fixed investment that holds a little longer maturity date holds that higher rate of interest longer and subsequently becomes more attractive in a declining interest rate environment. So that part of fixed income looks pretty good. Now, where we may see a lesser outcome is when you think about savings instruments at the bank. Those savings instruments are tied to the interest rate environment. And with the Fed initiating rate cuts, we would expect certificates of deposit and bank savings, money market funds to start working their interest rates lower or downward, reacting to the Fed's cuts. And so that would be a little less positive. And that's where I think people should understand what the change in rates means. Review your portfolio to see if any changes need to be made. It's possible that none should be made, but you might look at that to see if some adjustments would be nominal or would be advisable within your portfolio.
Right.
And also I'd advise people don't change based upon the change in rates. Make an adjustment based upon rates, but make that change still focus towards your goals and the time horizon to those goals and your comfort with risk as an investor pertaining to that strategy, that time horizon, and those goals.
Right. Definitely a great time to review those goals, review your portfolios, make sure you're making adequate changes if you need to. Edward Jones can help with that. How can we get in contact with you, Gabe?
So there's several offices in the St. Joe area and Savannah area. Those that are looking for counsel can just go online and try to find a closely located office. We're on the South Belt down near the Tractor Supply and the Walmart. People can pop in and introduce themselves, and we'd be glad to learn more and schedule a time to dig in a little deeper.
Excellent. Well, Gabe Rockers with Edward Jones. Gabe, thanks for bringing us this great information, seeing how this will impact us.
And thank you guys again for having me. I really appreciate it.
Of course.
Have a good week.
You too.